Welcome to the Deep Dive, where we cut through the noise to bring you the essential insights from complex information. Today, we're taking a deep dive into the recent financial results of Tata Steel Limited. The quarter ended June 30, 2025.
Yeah, we've really pored over the official filings, the press release, their investor decks, trying to bring you a clear picture. Our mission really is to pull out the most important bits of knowledge, maybe some surprising facts, so you can quickly get what truly matters here.
Exactly. Get ready to uncover how one of the world's, biggest steel giants is navigating global market shifts and also making pretty significant strides in green tech, plus a fascinating small acquisition with maybe big implications for their sustainable future. Let's unpack this. So to kick things off, let's look at the overall financial heartbeat of Tata Steel this quarter. What do the top line numbers tell us about their performance compared to, say, recent periods?
Well, what's fascinating here, I think, is the company's resilience. For the quarter ended June 30, 2025, consolidated revenue from operations stood at roughly 53,178 crore rupees. Now, that was a slight decrease compared to the previous quarter, Q4 FY25, and also slightly down year on year.
So a dip in revenue?
Yeah, indicating, a bit of a moderation in volumes. But here's the kicker. The consolidated net profit for the period was over 2,007 crore rupees.
Wow, okay.
That's a significant improvement, both quarter on quarter up from about 1,200 crore and year on year up from around 918 crore.
Big jump.
Huge jump. And consolidated EBITDA was reported at 7,480 crore. That gives a margin of about 14%. And that EBITDA figure itself improved by like 11% compared to the previous quarter and 10% year on year.
So profit up strongly, EBITDA up, earnings per share too.
Absolutely. The consolidated EPS after exceptional items was RS 1.67, which is a really notable increase from 1.04 last quarter and just 0.77 in the same quarter last year.
That's a great aha moment right there. Profit way up, but revenue slightly down. So what factors help them boost profitability so much despite that dip in sales volume? What's going on there?
Yeah, it raises an important question about efficiency, doesn't it? Management highlighted that higher steel realizations played a key role. Basically, they got better prices for the steel they sold.
Okay, so pricing power helped.
Definitely. And critically, their ongoing cost transformation program delivered around 2,900 crore rupees in savings just during the quarter.
2,900 crore, that's massive.
It really is. This program targets multiple levers, operating KPIs, supply chain procurement, shows a strong internal focus on financial discipline. It's probably worth noting, too, there was an exceptional item loss of about 132 crore.
Oh.
Yeah, primarily related to an employee separation scheme in India. But even with that, the core profitability story is strong.
Right, that cost saving really stands out. Okay, so beyond just the quarterly numbers, Tata Steel is clearly making significant long-term moves. Where are they pouring money into for the future? What kind of investments are we seeing?
They're definitely looking ahead. The company spent about 3,829 crore rupees on capital expenditure just during this quarter.
Okay, where's that going?
It's being deployed into several key strategic projects. In India, for instance, their Big 5 MTPA blast furnace at Kalingagar is ramping up well. They've also successfully commissioned one of the two continuous galvanizing lines within their 2.2 MTPA CRM complex there.
CRM complex, that's the cold rolling mill.
Exactly, processing and coating steel. And caster number 3 is expected online in September 2025. This expansion is already showing its value. They've got great approvals for high strength and ultra high strength steel.
So getting into more advanced products.
Yeah, putting them on par with global leaders in like next-gen lightweighting solutions for cars and things. Also in India, construction's underway for an electric arc furnace, an EAF, in Ludhiana. Equipment erection has started for this 0.75 MTPA facility. They expect that commissioned in fiscal year 2027.
An EAF, that's a different way of making steel, right? More scrap-based.
Precisely. Generally lower emissions profile, especially if powered by renewables. And speaking of EAFs, a huge milestone was reached in the UK, July 14th, 2025. They had the groundbreaking for the UK's largest low-carbon steelmaking facility. That's an EAF at Port Talbot.
Ah, the Port Talbot project. Heard a lot about that.
Yeah, it's a central part of a massive 1.25 billion transformation, significantly supported by a 500 million investment from the UK government, too.
Big government backing there.
Definitely. And on the downstream side, closer to the customer, they've seen smooth ramp up of 230 KTPA color-coded lines in Kopoli and Maromandali.
Yeah.
And a 100 KTPA direct forming technology mill for making tubes was commissioned just in June 2025.
So lots of investment across the board, upstream, downstream, new tech, and they even made that quiet acquisition you mentioned earlier, the one that speaks volumes about their long-term strategy.
That's right. What's fascinating here is a smaller but I think very strategic acquisition. They approved putting up to first crore for a 26% equity stake in a company called TP Adarsh Limited, or PPL.
TPL, haven't heard of them.
No, they're new. Incorporated in October 2023, actually a wholly owned subsidiary of Tata Power Renewable Energy Limited. Hasn't even commenced operations yet.
Ah, so it's about renewables.
Exactly. The clear objective for Tata Steel is to, well, optimize its power cost and slash its carbon footprint. The plan is to replace traditional grid power with cost-effective renewable power generated by TPL.
Makes sense. Getting dedicated renewable supply.
And this acquisition is expected to be done within 3 months. They also completed the acquisition of Nilakal Ispat Nigam Limited, NINL, that was July 24th, 2025. NINL is now a wholly owned subsidiary.
Right, that was a bigger deal they won a while back. How's it contributing?
It contributed an EBITDA of about 224 crore rupees in Q1, and it's seen as a strategic lever for expanding their long products business think construction steel.
Okay, so these investments, both the huge EAF projects and the smaller renewable power stake, clearly align with a bigger global push. So what does this all mean for Tata Steel's ambitious sustainability goals, their journey toward decarbonization?
If we connect this to the bigger picture, yeah, their net zero emissions target by 2045 is really driving a profound transformation. You can see it across their operations. In the UK, that transition to scrap-based EAF steelmaking we talked about, it's projected to reduce 50 million tons of CO2 equivalent over a decade.
50 million tons. That's a huge number.
It is. The aim is to bring CO2 emission intensity down from like 2 tons of CO2 per ton of crude steel to about zero point 0.4 tons.
Massive reduction.
Yeah. Key equipment orders are in, planning permissions received, it's moving forward. Then, for their Netherlands operations, they're in advanced discussions with the Dutch government, trying to secure support for an integrated environment and decarbonization project there.
What's the plan in the Netherlands? Similar to the UK.
It's a bit different, a phased approach. Initially, shut down one blast furnace and replace it with direct reduced iron, or DRP, and EAF technology, and crucially, with the potential for using hydrogen or biomethane as the reductant.
Hydrogen steelmaking, that's the holy grail, isn't it?
Certainly a key pathway. Then a second phase would see the remaining blast furnace shut down, a full transition to greener steelmaking. They're committed to achieving a 35–40% reduction in emissions there.
Significant commitments in Europe. What about India?
In India, the initiatives focus more on process improvement, carbon direct avoidance, and also carbon capture and utilization, CCU. They're actively exploring breakthrough technologies, things like Hizarna and Easy Melt.
New processes entirely.
Yeah, aiming to reduce coal usage significantly and optimize carbon intensity right from the start. They've also launched something called India's first carbon bank to further carbon abatement efforts. It's quite innovative.
A carbon bank. How does that work?
The details are still emerging, but the idea is likely around internal carbon pricing or trading mechanisms to incentivize reduction projects across different units.
Interesting. And are they getting recognition for this stuff?
They are. Their Noah Mundi iron ore mine received a 7-star rating from the Ministry of Mines for scientific and sustainable mining. Only 3 mines in India have that. Plus, over 90% of their Indian steel production now comes from responsible steel certified sites.
That's a big certification.
It is. And the company was also recognized as a Global Diversity, Equity, and Inclusion Lighthouse in 2023. So recognition on multiple fronts.
Okay, let's switch gears slightly and dig into the operational nitty-gritty. We talked about that impressive cost efficiency. How are their actual production lines running, and how exactly are they squeezing out those savings we mentioned?
Right. Well, as we noted, the headline numbers for production and deliveries showed some dips in Q1. Consolidated crude steel production was 7.33 million tons. That's down from 7.45 last quarter and 8.00 million tons year on year.
And deliveries followed.
Yeah, similar trends, 7.12 million tons, down from 8.33 QoQ and 7.39 YoY. But again, the context is key here. Production and deliveries were specifically affected by planned maintenance shutdowns.
Right, you mentioned the blast furnace relining in Jamshedpur.
Exactly. The G-Blast furnace there, plus work at Nilachal Ispat Nigam Limited. Management expects these volumes to normalize in the coming quarters. It wasn't a demand issue.
Got it. So, volumes aside, how did they achieve those Rs 2,900 crore savings?
It was broad-based. Things like raw material efficiency, optimizing stores, repairs, and maintenance,
Hmm.
also refining their sales mix, selling more profitable products, improving supply chain logistics, managing power and fuel costs better. They actually showed 98% compliance with their Q1 plan for these initiatives, which is pretty remarkable execution.
There's almost perfect execution on the savings plan.
Pretty much. And a
Okay.
really remarkable detail. The India EBITDA per ton, that's profit per ton, produced in India, significantly improved. It jumped by Rs 2,510 just quarter on quarter, reaching Rs 15,760 per ton.
Huge margin improvement in India then.
Very strong. And they're also leveraging digital tools more, using artificial intelligence models to drive improvements in manufacturing.
AI in steel making.
Cross-yield, energy efficiency, throughput, quality, productivity. And their e-commerce platforms are growing fast too. Platforms like Ashiana for home builders and Digika. Their gross merchandise value, or GMV, grew 52% year on year. It's at about 5,400 crore on an annualized basis now.
Wow, digital channel is becoming quite significant. So what does this picture look like across their global footprint then? How are the different regions, India, UK, Netherlands, contributing? And what challenges are they seeing?
Yeah, it really gives you that multifaceted view of their global reach. India operations, as you might expect from that EBITDA figure, remain the powerhouse. Revenues of 31,137 crore rupees, a really robust EBITDA of 7,486 crore. That translates to a strong 24% margin.
24% margin in India. Impressive.
Very. Now, deliveries were broadly flat year on year, again due to those production constraints we talked about, but management emphasized success in selling higher value-added products and, capitalizing on those new facilities coming online.
Like the automotive steels.
Exactly. They're consolidating their position as a preferred steel supplier in automotive. Achieved their best ever Q1 sales in high-end auto products. Those now represent 25% of their auto sales mix. And it's interesting, their retail brand, Tata Tiscon Rebar, sales have doubled in the last 5 years.
Doubled. Wow.
And they've seen fourfold growth in their solar segment sales, too. So targeting specific growth areas.
Okay, what about Europe? UK first.
UK operations reported revenues of 536 million. What's really notable there is the EBITDA loss improved significantly. It was down to 41 million loss compared to an 80 million loss in Q4 FY25. So moving in the right direction, but still a loss.
Why the loss still?
Well, deliveries were marginally lower at 0.60 million tons. They cited subdued demand and a generally fragile UK economy. UK steel prices are apparently still below where they were a year ago. So tough market conditions.
Understood. And the Netherlands?
Netherlands operations showed strong improvement, actually. Revenues were 1,519 million, and EBITDA jumped to 64 million. That's a significant gain from just 14 million last quarter.
Big turnaround there. What drove that?
Liquid steel production reached 1.70 million tons, which is near rated capacity. So good operational performance. Plus, they benefited from a favorable sales mix and higher realizations, especially in their downstream businesses there.
Okay. And the broader market picture, you mentioned prices moderating.
Yeah, globally, steel prices generally softened between April and June 2025. Germany, for example, saw about a $100 per ton decline from its peak. Steel spreads, the difference between steel price and raw material cost, actually improved in Q1 because raw material prices dropped more sharply.
Ah, so margins got a bit of a temporary boost from input costs falling faster.
Exactly. But they noted there's renewed pressure on spreads starting in July, so that might not last. India's steel demand, though, continues its growth trajectory, supported by government infrastructure spending. Although, interestingly, India remained a net steel importer in the first half of FY26, despite having a 12% safeguard duty in place.
Still importing steel even with duties.
Yeah. And EU steel demand has been kind of sluggish, affected by broader macro dynamics and policy uncertainty over there.
Okay, so a mixed picture globally. Now, pulling it all together. Ultimately, how strong is their financial foundation? What does the balance sheet tell us about their ability to actually absorb all these massive investments and navigate this market volatility?
Yeah, connecting this to the bigger picture, their financial discipline is absolutely key to making this whole strategy work. Net debt stood at Rs 84,835 crore as of June 30, 2025.
84,000 crore. How does that compare?
Well, it actually reflects a disciplined approach because it's a reduction from the gross debt figures they had back in March 2025 and even a year ago in Q1 FY25. They're managing it down.
Okay, so debt levels are being controlled despite the capex.
Yes. And the company maintains a very strong group liquidity position. 43,578 crore rupees. That includes over 14,000 crore in actual cash and cash equivalents. so a good buffer.
Plenty of cash on hand.
Right. And if you look at their consolidated financial credit metrics, the EBITDA margin we mentioned, 14.1%, their net debt to EBITDA ratio is 3.21x. Net debt to equity is 0.91x.
How should we interpret those ratios?
Well, 3.21x net debt to EBITDA is maybe a touch high for some industries, but for a capital-intensive business like steel undergoing transformation, it's manageable, especially with improving EBITDA. Below 1x net debt to equity is generally considered healthy. Their interest coverage ratio, how easily they cover interest payments, is 3.6x. Again, reasonably comfortable.
So the metrics show a company managing its finances pretty prudently while still investing heavily.
That's the picture. They're focused on maintaining financial health while pursuing this ambitious growth and transformation. They're actively optimizing their capital structure, like bringing more debt onshore to India, and managing working capital very effectively to maximize cash flows. This strong balance sheet is really foundational for those huge decarbonization and expansion plans we discussed.
Okay, so wrapping things up, what does this all mean for you, our listener? We've seen Tata Steel navigate a, well, pretty dynamic global steel market with impressive financial resilience, strategic investments, a real laser focus on cost efficiency, and this unwavering commitment to sustainability.
Indeed. I mean, their Q1 FY26 results really underscore a company that isn't just reacting to market conditions. They
Oh,
seem to be actively trying to shape their future. You see it in the significant capex in advanced steelmaking, that pioneering push towards decarbonization in Europe and India.
eh,
Even those smaller strategic acquisitions like the renewable power stake and how they're harnessing digital innovation, Tata Steel is clearly evolving.
right.
They're leveraging, as we said, a robust balance sheet and
Yeah.
strong operational discipline to transform the business and really trying to capitalize on long-term trends, particularly, you'd have to say, in the growing Indian market.
It's a really fascinating look at how a massive industrial player isn't just, churning out materials, but is also proactively building the infrastructure for what looks like a more sustainable and technologically advanced future. So, for you, our listener, thinking about all this, what's one big idea to perhaps ponder after this deep dive?
Okay, consider this. We're in an era where entire industries face just immense pressure to decarbonize, right?
Absolutely.
So how might Tata Steel's multi-pronged strategy, it's globally coordinated, aiming for net zero by 2045, how might that strategy, combined with these significant government partnerships we saw, plus that relentless focus on internal efficiency, how might all that create a durable competitive advantage, one that extends, far beyond the traditional metrics of just cost or market share?
Mm, a different kind of advantage.
Yeah. Could this approach ultimately redefine not just their future, but maybe the very definition of what a sustainable industrial giant looks like in the 21st century? Something to think about.